thank you very much to the authors from the report. All four authors are here to present a very interesting report. And of course, discussants, as always, at Bruegel, we have a discussion on the issue. We are here to discuss a CEPR report that was written on where we are on financial regulation. Are we sound at last? Very interesting title. And the authors have very kindly agreed to come and present it today. Very quickly, if I could present Patrick Bolton on the end of the line. Xavier Weiss here on my right. And then on the other side, we have Matthias de Waterpont, who is very well known here at Bruegel, and of course our very own Rebecca Christie, who both of them will be discussing briefly their report after the presentation. We are going to take about 30 minutes for what I believe is a joint presentation. Is that correct? Then we will take maybe 10 minutes each for the comments, starting with you, Matthias, and then you, Rebecca. And of course, the other two authors are also here. If I briefly introduce you, Stephen Cecchetti, who's sitting here at the front, and Jean-Pierre Dantin, also here at the front. Thank you for joining us. I think we should probably make a start, given that we have a big report ahead of us. You can use the slider here, and the floor is yours. Thank you for coming.
Thank you very much. So thank you Bruegel and to you to host this event. So we are very happy to present it here after our London presentation. I also would like to thank the discussants, Rebecca and Matthias, for agreeing to discuss this report. So this report is part of a wider initiative at IESE on fostering research in banking, and one of the activities will be to try to have a report every year on some topic of interest in banking. So this is the report, so that you see that it exists, apart from your electronic version that you can download at the CEPR website. So let me just start with some general remarks on the banking industry in the aftermath of the crisis. Since then, regulation and supervision has improved. Banks are better capitalized. Authorities pay more attention to systemic risk. So this is something that went unnoticed in the run-up to the crisis. So that these are clear improvements. However, still, we have things to worry, like, for example, high levels of debt, high sovereign debt to GDP ratios, and in fact, very low and persistent levels of interest rates. And as we'll see, we may be on the verge of currency wars between different major players, as we are learning as we speak, basically. Also, a point that we make in the report is that it seems that the regulatory authorities sometimes seem to lack the political support to take forward the reforms and appropriate regulation. For example, some powers to the Fed were taken out post-crisis via Dodd-Frank. And in fact, as Stan Fischer just remarked very recently also in Sintra, and as Ben Bernanke, Paulson and Geithner also remarked in an article in the Wall Street Journal. So if the crisis were to happen today, the Fed would have less powers to intervene than at the time of the crisis. So the general idea to end bailouts is sound, but not taken to an extreme. In particular, for example, in Europe, we still have pending the completion of banking union in the eurozone, and this still there's, for example, the deposit insurance pillar and a true backstop to the banking system is still lacking. And what we think is that some unrealistic commitments to end bailouts, no matter what, even on the face of a big macroeconomic shock, since they are not realistic, they would not be fulfilled, and this lends, in fact, implies a lack of credibility in the policies which are fostered. Apart from that, the credibility of the regulators is at stake for another reason, which is sometimes politics is the very source of instability. As we see, central bank independence, and this is a topic also on the chapter 3 of the last chapter of the report, is the very source of of instability. Central bank independence, for example, has been attacked. Obviously, in the US, is constantly attacked in the US. It has been attacked in India and in Turkey and in other places. And so this is the frame with which we have to work with. Looking forward, the next global crisis, well, who knows where it will be, but if the past is any predictor of the future, we know that activities in the periphery of the core functions of banks, with shadow banks, typically have been at the forefront of crises, like in 1907, in the panic of 1907, the one that JP Morgan helped to stabilize, or in the 80s with the crisis in the savings and loans after liberalization, and with the entry of mutual funds, money market mutual funds in the US at the end of the 70s, or in the current crisis, as we know. So the challenges are large. Apart from that, obviously, the next global crisis could also emerge and be systemic in different countries like China, unless we really walk towards a two-world, at least, a big separation, East and West, which is also possible. So the challenges for both banks and regulators are very important. Incumbent banks must adapt to digital disruption and to the increasingly competitive environment this has created. On top, interest rates are persistently low. They still some have a legacy of bad loans, and they have heavy compliance. Okay, so it's a kind of it's not an easy time, in a sense, to be an incumbent in the banking sector. Regulators must try to maintain a playing field at the same time that protect financial stability. So they may encourage entry, but obviously taking into account that entrants that may become, or activities that may become systemic, they have to be taken into account. So, for example, in Sintra, very recently, Mark Carney of the Bank of England was asked about Libra, and what was the digital currency that Facebook is starting, and said some very sensible things that, well, if it becomes systemic, so then obviously we have to, we are open to it, open to innovation, but it will have to be regulated and comply with the different controls that systemic activities require. So this will be this balance between allowing innovation, but at the same time preserving financial stability. Okay, so the three main chapters are a first chapter on looking at what has been done at Basel III and beyond, a second on resolving too big to fail, and a third on the enlarged role for central banks. Now, in the remaining time I have, will talk very briefly on the first one, and Patrick will talk about the last two chapters. So, just to start with an observation. The observation is that after any major crisis, the proposal to move banking to a narrow bank status, where basically all the investments of banks would be extremely safe, like government bonds in the US, for example, and then that's it. So basically killing the maturity transformation function of banks surfaces. So we think that this would not be a solution, because the fragility, maturity transformation is necessary, will continue to happen, maybe outside then these narrow banks, and therefore the problem would be reproduced at another scale. So that's just a general comment that I think it's important to make. And two other general points out of the report. The first is that prudential regulation should take a holistic approach, so that the view that we can set, or regulators can set, capital, liquidity, disclosure requirements separately of each other is not very sound, because they are interactions. So, for example, if you increase disclosure requirements that may serve as coordinating devices of runs, you should at the same time think of potentially increasing liquidity buffers, so that institutions have more room to withstand runs, or in a more liberalized environments, like it was happening in the savings and loans crisis, or previous to the savings and loans crisis, the regulators should have thought of increasing capital requirements. Okay, so these things have to be thought together, and we have some things to say on this. On stress test, stress test, we find it's a very useful innovation that will help to keep financial stability, and in particular stress tests are very useful if well designed. And for this, we think that they need to be severe, otherwise there's not much point in it, and the European ones is not obvious that they have been severe, flexible, and not overly transparent. Flexible because this is dynamic and they have to adapt to circumstances, and not overly transparent so that banking institutions do not have the ability, in a sense, to just study to pass the exam, okay, as sometimes it may happen. At the same time, they would need to incorporate a systemic perspective and second round effects, and so this is not still it's not easy because we do not know enough, perhaps, but it's something that has to be considered. With respect to the euro area, the point we make is that it's very difficult to make and to have effective stress test when before in this case the eurozone has not built an effective backstop for the banking system. Okay, so you cannot give bad news when you don't have when you're not prepared to really confront those bad news. Three comments on capital liquidity and on non-banks or shadow banks. First, on capital requirements, the levels are up, but they are enough. And then on liquidity and non-banks. So capital requirements, so this is a sample of 66 international banks, and we see that since the crisis, really, capital requirements are up, both on a risk-weighted basis and on a leverage ratio, so an equal weight basis. So there has been an important increase on both accounts. The question is whether this is enough. So if we compare what's been happening now with the base that we had at Basel II, requirements have increased, real capital requirements have increased maybe even tenfold. So if we think of a Basel III range of 8 to 10%, the Basel II baseline was 4%, but then we will start with the deductions that were allowed for hybrid capital, goodwill, deferred tax assets, adjustments for the risk weights. So the effective Basel II converted to a Basel III baseline was very small. Okay, it was very small. So then the issue is whether we are at the right level of capital requirements, and there is a lot of academic debate on that, because obviously more capital sometimes impairs lending and may induce the shadow banking sector to grow. There is some evidence of that, although it's not uniform. So, for example, in the US, mortgage lending has moved quite a bit towards shadow banks and in good part fintechs, and this, according to the empirical work, is because of the extra requirements that banks face, not necessarily capital, but the extra requirements that banks face. But in any case, so this is still something it's up in the air, and we discuss these issues in the report. Also, we have to take into account, as maybe Patrick will mention, that on top of the core capital, there is TLAC and MREL, so extra capital cushions that increase the capacity of banks to absorb shocks. All in all, we still think that if we have to err on the capital requirements, perhaps it's better to err on the high side, although the cycle where you increase capital is very important. No? So capital has to be increased in expansions and not in recessions. Okay, so this is typically a very bad idea to try to increase capital on recessions. Okay, 1 point on liquidity and 1 point on non-banks, and I'm done. So here, now this is heavy mathematics, this slide, so be prepared. That's a balance sheet of assets and liabilities, and there is some balance sheet arithmetic. So this here we present an extremely simplified balance sheet of a bank, where assets we have liquid and illiquid, and liabilities we have runnable and stable. So stable long-term debt may be unstable, even maybe insured deposits could be unstable, okay, in this. But in any case, so the idea of the liquidity, the first requirement, the LCR requirement, is that liquid assets are larger than runnable assets with a certain period, etc., certain constraints. Okay, so this puts obviously one constraint, and then the net stable funding ratio puts the constraint in the other on the other direction, that the stable liabilities should be able to finance illiquid assets. Okay, so the question is whether we need the two. Okay, look at this, at least in this simplified perspective, with one should be enough after some deep mathematical thinking. Obviously, there are other issues that have to be considered, but at least this is some food for thought whether we need the two, and that's an issue that we put on the debate to be considered. Finally, on non-banks. The global financial system assets here by sector, 2007, 2017. The yellow thing are the non-banks. The gray thing are the banks. So non-banks have increased the market share. So this will be shadow banks in a general picture, while banks have decreased it. So here, this is global, and this hides a little bit really differences. So, for example, in the US, banks recover somewhat after the crisis. Shadow banks also suffer quite a bit. In Europe, the decline of the market share of banks, of tricky banks, has continued after the crisis. In any case, here what we propose is that for those entities outside the perimeter of regulation, authorities require a framework to monitor them, to assess the risk they have, designate them, that's to say which ones would be systemic and could be a danger, and this need not be obviously inside the perimeter, but outside the perimeter. So, for example, should a data and data analytics provider to some systemic banks should be considered systemic, this institution, or not? Okay, given that now banks are outsourcing many are outsourcing many of those services. Some providers may become systemic, and then they should be regulated and supervised. Note that shadow banks are large. So, for example, the largest money market mutual fund is Yubao, in China, and these funds may be subject to runs, as we saw, for example, in the US, although there are some specificities there. So in any case, this is something that needs some systematic approach. And I finish here and I pass the baton to, to Patrick.
That was quick.
Okay.
That was exciting and timing. Great, thank you.
It's a pleasure to be here, and thank you all for coming, and I hope you'll find today's presentation and maybe also the report of interest. So I will be talking about two topics which are traditionally not discussed when one thinks about bank regulation. First topic is resolution, and the second topic is the new role of central banks. So let me start with resolution. We've come a long way. Resolution wasn't really on the table when the crisis hit in 2007. Here are just two quotes that will tell you why this wasn't on the table. So both are from Tim Geithner's in his book on stress tests, which I highly recommend. So first quote, let me read it. Haircuts send a destabilizing signal that more haircuts are coming, encouraging runs on financial firms. Unfortunately, the only way for crisis responders to stop a financial panic is to remove the incentives for panic, which means preventing messy collapses of systemic firms, assuring creditors of financial institutions that their loans will be repaid. Okay, and in the end, that's where the authorities had to go after the Lehman failure. Incidentally, Tim Geithner was opposed to the Lehman failure. He wanted to save Lehman. Another issue that we have become aware of during the crisis is cross-border insolvency issues for global systemic banks, and the example of Barclays and Lehman. The issue is nicely summarized by Alistair Darling in an interview he gave. I said that we would not endorse it because basically what you're asking me to do is to transfer the burden of a bust American bank onto the British taxpayer, and there's no way we can do that. Okay, that's loud and clear. That's a very important issue. Cross-border insolvency issues were also very difficult in a more, you would have expected in a more favorable context, whether it was Dexia, Fortis, or Anglo-Irish. These were very messy resolutions. A third important issue when it comes to global banks is the business model. A business model is not a simple one of lending to households and corporations and taking deposits. Business model involves many other activities, in particular derivatives trading and derivatives and swaps books, which are huge for the very large financial institutions. The problem with derivatives and swaps is that counterparties are exempt from automatic stay rule that applies to debt contracts in bankruptcy. Concretely, what happened to Lehman when Lehman failed for Chapter 11? It was drained within a few days of all its cash because all the swaps and derivatives counterparties were coming in and grabbing all the cash. Lehman broker-dealer arm couldn't operate. It had to be sold at 10 times less the price within 1 week of the bankruptcy. That's a very big problem.
Do you point out anywhere that Lehman was not a bank at that time? Because that played a big role.
It was a broker-dealer. It was not a bank holding company.
Right, but I just, since you didn't say it explicitly for people who might not have been glued to the markets then, it was outside the bank resolution framework. It was a shadow bank, and it is the point, but you're getting there in such a graceful and elegant way that I worry it's people aren't seeing the connection right away.
Thank you for clarifying. This is a very important issue. Okay, and it also goes back to what Xavier said at the beginning of his presentation. The crisis of 07 or 08 did not originate in the commercial banking sector. It originated in the broker-dealer sector. And the problem with that is precisely what you said. Broker-dealer sector did not have a resolution procedure that was adapted to its business model, like FDIC receivership. That's much more adapted than Chapter 11 bankruptcy. It had to be treated like a non-financial corporation. And it wasn't just Lehman that ran into problems. It was Bear Stearns. Bear Stearns was saved, but the Fed had to go to incredible hoops to save Bear Stearns, and it could easily have failed as well. So that was a huge area of vulnerability, so I'll elaborate on that in a second. Another big problem is, you look at these banks, these large banks, they have literally thousands of affiliates all over the world. Okay, so how do you do a resolution of such a complex institution? So, good news is we've come up with an idea that if it works, it's like a brilliant solution. Of course, it's a big if, but I'll turn to that in a few minutes. What's the idea? The idea is that resolution should only happen at the holding company level and should not touch the affiliates. Affiliates should remain as going concerns, business as usual. Now, there may be multiple bank holding entities. There could be a parent, and then there could be intermediate holding companies, and then this general idea could be extended to intervening at multiple holding company levels. That's the multiple point of entry idea, which is the counterpoint to a single point of entry where you have a single parent, a single holding company structure. Okay, so that's a brilliant idea because you're really focusing where you're intervening. You can simplify that. You can prepare for that. So here's the idea. So think about Lehman, for example, here with its main affiliates, UK and US. If we had had a single point of entry model for Lehman, basically the intervention would have happened only in the US, and the losses could have materialized in London or Singapore, other parts of, but the losses would have been pushed up to the holding company, and if the holding company, as a result of taking on those losses, was insolvent, you would write down the debts, long-term debt that the holding company had issued. Okay, that's the single point of entry model. More elaborate one is multiple points of entry. So, like for example, HSBC or Santander prefer that model, and basically what it means is you have holding company structures in multiple jurisdictions. Okay, so that's essentially the added complexity. Now, of course, if you're going to do a resolution at the holding company level, only keeping everything else intact, in particular, keeping all the creditors, all the counterparties of the affiliates whole, you have to make sure you have enough of a cushion to eat into at the holding company level. That's the TLAC idea, total loss absorbing capacity. That's what's been added to regular capital requirement cushion. This is what Xavier was alluding earlier. This has become very large. So, for example, the 5 largest U.S. Bank groups, if you add up their equity capital plus the TLAC, the long-term debt that they've issued, the whole thing exceeds 30% on a risk-weighted asset basis. They're very well, on that basis, extremely well capitalized at this point. Resolution requires liquidity support. That's a theme that we are emphasizing in the report. Is something that people would rather not touch in some quarters. In the U.S., some people believe that once you've done resolution, you don't need liquidity support anymore. But we are arguing in the report that this is an untested model. These are global banks. There's so many things that could go wrong. Very little trust will be put into this system when it's tested, if it ever gets tested. Markets won't have much confidence in it. And so to make sure that it works, you have to also come in with a backstop. And this is coming back to what Xavier mentioned earlier. What Dodd-Frank did to restrict the Fed's ability to intervene is a big weakness in the system, because the Fed won't be able to come in with a very a credible backstop in the next crisis. Last point on resolution, which I want to mention, which is an interesting one. So one side effect of this model, single point of entry model, is that the idea is that these global banks, they're there to stay forever, because even if they run into trouble, what will happen is just that their long-term liabilities will be written off, and then they'll continue. All their operations will continue. So it's a very strange form of resolution. You're not coming in and saying, well, you don't have a viable business, this is no longer working, we're going to close you down, right? So that's really up to the bank management and bank shareholders to take those initiatives. So that's, I think, an interesting side effect of the new rules. Okay, let me turn now to expanded role for central banks, which is a very important part of our report. Central banks have been drawn into a traditional role that they had to play when they were created, but that had been forgotten. And the traditional role is to support banking system in times of crisis, to act as a lender of last resort. That's why the Fed was created. That's why the Bank of England was created. You look at the history of central banks, that was their original purpose. And we've come back to that purpose. So now we have a much larger, if you want, role. Well, understand we have a much larger role for central banks. We also have new challenges. The monetary policy in a zero lower bound environment. And so one of the very important themes that we touch on in the report is the theme of central bank independence in this new enlarged role. And we point out that there's a risk that this may, the whole new role may be just too big for an independent central bank. And what's at risk is the independence of the central bank. And so we need to think very carefully about central banks' roles in order to preserve probably the most valuable feature of central banking in recent years, that we've developed in recent years, which is their independence. Much of what we are saying is summarized nicely. Paul Tucker wrote a whole book about this, but I'm just going to give you a quote from his book. In today's democracies, the only way to combine effectiveness with legitimacy is transparency around the rules of the game. Credible commitment originating as an emergency institution can be reconciled in principle, getting from principle to in practice requires public deliberation and debate, so that the requisite degree of comprehension and support is established. Okay, so that's really very much a theme that we build on in the report. Transparency, public deliberation is key to preserving independence of central banks in their expanded role. Okay, so one particular challenge in the expanded role that central banks face today is the zero lower bound. In a way, in very simple terms, once you reach the zero lower bound, once interest rates hit zero, nominal interest rates hit zero, the tools that you're going to use as for monetary policy purposes are going to be looking like more and more other policies. They're going to look more like fiscal policy than monetary policy, if you want. So it creates a major issue, it raised a major issue, the policy mix at the zero lower bound. Very often you hear central bankers say, you're asking us to do too much. We would like to be able to rely on the fiscal side when we reach the zero lower bound. We would like to better coordinate with fiscal authorities. And so here what we're saying is that, yes, this has to be, policy coordination has to be facilitated one way or another at the zero lower bound. And that requires rethinking the practice of independence at the zero lower bound. Particularly, it requires allowing for public deliberation between independent central banks and fiscal authorities. And it requires giving up on strategic ambiguity. Strategic ambiguity cannot be reconciled with an idea that you have the fiscal authorities, monetary authorities talking with each other, coordinating an intervention while maintaining independence of the central bank. Another point that we emphasize in the report, this is highlighted here in red on this slide, is that, you can't dispense with the backstop. The backstop has to be there. Backstop can be seen as a subsidy to the financial system, to the banking system that has access to central bank liquidity. If you're going to give that subsidy, if you allow banks to survive because they have access to that subsidy, then the counterpart should be tighter regulation of executive remuneration, executive compensation at these banks. You can't have a heavily subsidized bank with a CEO that earns, tens of millions of dollars, like let's say the CEO of a non-financial company who doesn't get any subsidy, right? So that's not really, we argue, that's not really justified. So one of the challenges in the expanded role for central banks is how to organize this cooperation between the fiscal and monetary sides of crisis resolution policies. This will be my last slide. The institutional issue that you're facing here. So when you have an expanded mandate for central banks, well, what is it again? So you have the traditional monetary policy, you have prudential regulation, and you have unconventional policies when you hit the zero lower bound, right? So it's a lot of stuff, and as I said, if you want to preserve independence of central banks, maybe there's an argument for saying, well, they shouldn't do all of that, all of these things. Maybe we should farm out some of these functions to other agencies, which is the case in a number of jurisdictions. Now, the one country that stands out under the integration model is the UK. Now, we recognize that this is not necessarily a feasible model in other jurisdictions. And so we're not trying to say, well, have everyone follow the UK model. You have to recognize institutional constraints in each jurisdiction. But we should also be aware that if you're not going for the UK model, you're going to create fragility in terms of coordinating actions, and those have to be addressed. And the way we recommend they be addressed is to allow for open communication between the agencies. In a situation when you hit the zero lower bound, which we argue will be the best way of preserving the independence of the central bank. So let me stop here.
Well, thank you very much, Martin. That's great. Thank you both for sticking to the time. I think we should move straight ahead to the comments. If I may have the
Yep.
then we can do that. Yes.
Okay, thank you very much for the invitation.
They will put this on.
Thanks a lot for the invitation. Thanks a lot to the authors for having written a very nice and very readable report. So it was a pleasure. It's also very rich, so I will only, in my 10 minutes, have the opportunity to talk about a couple of things. And in particular, I will focus on the first two of the three big chapters. It's great also that the report shows that the team combines academic expertise and high-level policy experience. I'm in agreement with most points. There are a number of things, though, that are not that eurozone-centric, and I will focus a bit more on that, given that we are in Brussels. And so I will talk about four topics: the health of eurozone banks today, Capital Markets Union, very briefly, and then Bailin and cross-border banks. But in these topics, I will talk about the various recommendations of these two chapters. So, as was said, things are better now than in 2008, thank God, of course. It was not that difficult. Now it's 10 times more capital and so on. But of course, 10 times of almost zero is still not great. So let's face it. This being said, it's difficult in Europe to ask for more capital because capital is not that remunerative. We talk about typically a cost of equity of 10%. That's because, of course, there is such high leverage, therefore it's very risky. And when you look at the various countries, the Netherlands and Belgium are okay, France a little less good, Spain and Italy are not bad, Germany 3%. Germans seem to be not as good as banking as in cars. So, frankly, we'll come back to that. In particular, because there is Deutsche Bank. Well, as said in the report, of course, US banks are doing better today. So a couple of numbers. I just took assets, total assets. Of course, it's a bit fishy because I'm looking at the market cap and not at the accounting equity, but still, look at Deutsche Bank today, market cap 13 billion, which is 0.8% of their balance sheet. So, job not done yet. Some banks are doing better. The button number, the first four are GSIBs, and they are all Two of them are below 3%, and then ING is 4%. So not, as I say, it's not that great. Of course, part of the market cap business is the potential threat of the GAFAs and so on that could change the business model and so on. So, but still, I mean, some are not that great. So thinking about Bailin and so on is not a bad idea. Very briefly about capital market union. Everybody in Europe says we are too much bank-centric and that's therefore debt-centric, and they show we should do capital market union. As the report says, why are we always complaining about excessive leverage while subsidizing debt over equity through the tax system? I once was told, in fact, by Paul Tucker, that this thing is bigger than the FSB. You cannot touch it. This is fiscal policy. I think one point I want to make is that of course, the report says, look, stricter regulation of the official banking sector means migration towards shadow banks, and that can be a problem. Note that capital market union is also about increasing shadow banks, asset managers and so on. That's a move from debt to equity. That's not that bad. So I think that your 5-item idea of looking what these animals are like and so on, I think goes in indeed the right direction. Even if, of course, some of these things are pretty big and therefore their lobbying is quite powerful, and so we are definitely not there yet. But I think it's important to keep in mind that some of these shadow banks are definitely an improvement over regular banks if you are worried about too much debt. Now, Bailin. Everybody is now for Bailin. Everybody is against bailout. By the way, everybody is in favor of backstops. And backstops and bailouts are in fact synonymous. It's about putting public money into banks. So I think as a trick to the public at large, as a trick for the public opinion, having a new name might be helpful. But let's face it, not completely rigorous. Now, by the way, more important, Lehman was Bailin. That trigger, of course, a complete bail-in in the sense that rather than having taxpayer money, you have the creditors having losses. That was the only place where that happened. Of course, there was also Iceland and so on, but in terms of in countries where these were not too big to save, you didn't have bail-in except for Lehman, which was a disaster. As you say, it triggered a change in equilibrium. Diamond Didrik, I think, is the best way to understand Lehman. Of course, part of it is bad coordination. All these runs are rational. Part of it is information-based.
Yes, I have no idea what Diamond Didrik is. Can you just give us the 2-second explanation?
So it's basically the idea that, so it's a model of a bank without deposit insurance. So today, think wholesale deposits. By the way, in that sense, Lehman, that was an investment bank, had only wholesale deposits, so no insurance. And the view is in this kind of model, when nobody runs, then it's your interest not to run. But when everybody runs, the bank will go under, and therefore, it is a dominant strategy to run. So in that sense, and the problem is that, what went wrong with Lehman that will not go wrong anymore with in the other cases. I think the key, and I think people understand that well in the bail-in, is that in order to, what you don't want to have in a bail-in is to have short-term creditors at risk because they can run away. So in this world about so-called orderly resolution, I think there is at times, and even a bit in the report, a bit too much focus on we should have treated the depositors of Lehman differently. They should have had a better idea of what they were going to lose and so on. I think that's not the point. If you understand that you will lose something, knowing it in 3 years or knowing it in 2 weeks, you want to run. Of course, Lehman depositors could not run, so they are not important. What is important is the bank next door. And that's exactly what Tim Geithner's quote was. If I'm with Fortis and I think, maybe I will be treated like Lehman, then I run. And so that's the key problem. And indeed, some people say it's only true for big banks because of the interconnection and so on. Beyond the mechanical interconnection, that indeed, if a big bank fails, then some other banks who are creditors will be in trouble, but there's also the informational interconnection. For example, today, if a bank in the eurozone fails, people will think, the NPL problem is worse than I thought, and if these guys were bailed in and I can run, I will run. So that is the key. Therefore, what we should do is concentrate the pain on claim holders whose money is stuck in the bank, and only there. In that sense, TLAC is much better than BRD, that you say in the report, because what you want to do is first build up the long-term junior loss absorbency, and then implement it. Here we did the opposite. From January 1st, 2016, we have this 8% rule that you have to bail in 8% of the bank, non-risk weighted, before you can think about putting some other money. And of course, we are not there yet. And therefore, second best, I think, is much better than implementing the 8% rule. We played around, found loopholes, and therefore, the Venetian Bank, national bankruptcy, or the Montepaschi precautionary recap, and so on. Okay, we are twisting the European law, but when European law is bad, it's better to twist it, frankly. So we haven't done it yet. And of course, that has meant procrastination. These problems remain. As I like to say, when bailout is out and bail-in is not in, denial is the only option left. And that's the story of resolution in Europe until now. Good news, however, BRD is getting better. There is a revision this month, better late than never, with stricter subordinated MREL requirement for banks bigger than 100 billion balance sheet, and, which is already very good, but that's definitely not enough. But there is the ability for national resolution authorities to go below that number of 100 billion, and I think that's crucial that every bank, because the TLAC is for 30 GSIPs. Here, BRD is for 6,000 banks, so every bank. So they should all have 8% subordinated. Belgium is doing it, the macroprudential authority, the National Bank of Belgium. I think everybody should do it. By the way, one comment on the incomplete banking union, European deposit insurance not being there, and so on. There is a lot of excitement, the Commission versus Germany and so on. I think it's a bit symbolic. BRD has made the deposit insurance fund so senior that it's not risky anymore. So the idea that we should insure, that the first thing should be to insure the insurer, you don't find that in introductory economics classes, but you have it, no bailout, and we are still waiting for the backstop. So, but anyway, so that's the, so I think things are improving, but there is still some way to go. Finally, if I have 2-3 more minutes, another big topic in Europe is cross-border banking, and the fact that we need cross-border banks. The ECB is in favor, the SSM is in favor. Of course, the big banks that hope to grow are in favor. I think we do have overcapacity. We could accelerate restructuring, these kinds of things. It should help monetary transmission, all that stuff is true. The question is, will it allow for more risk diversification or instead exacerbate the too big to fail syndrome? I would make 2 points on this. First of all, indeed, our retail markets are still extremely non-international. The top 5 countries in the eurozone, so Germany, France, Italy, Spain, and Netherlands, have more than 90% of their domestic assets by domestic banks. Belgium, which is the number 6 in terms of size, is an exception because of ING Belgium and BNP Paribas Fortis, we have 50% that are so. And I'm talking about 90% or 50% of domestic that is non-foreign branches nor foreign subsidiaries. So very, very concentrated. So there could be reason to try and go international. By the way, one advantage would be that it would reduce the sovereign bias, because BNP Paribas Fortis has a lot of Belgian debt, and BNP Paribas has French debt, and so on and so forth. So that could help. I think we all agree that we have too much sovereign concentration. I don't think Basel will do anything about it. I mean, I've never seen supervisors saying in such so forcefully that their governments don't want to talk about that. So let's forget about it. It's only the eurozone which has a specific problem. 19 countries without one central bank, with only one central bank. And so maybe we can go to concentration risk weight, something like that. This will be difficult, but maybe as part of a package. The good news is that would also solve partly the other problem, which is the home economy bias. Because, if your sovereign defaults, even if you don't hold it, your economy will collapse and you will collapse as a bank. So we also need to think about diversification there. One idea could be to introduce concentration risk charges, if we go to that, only at the consolidated level of the bank, not at the subsidiary level. Because indeed, international banks do have domestic sovereign concentration country by country. And so in that sense, that could be an interesting idea. Of course, this cross-border banking, you have the problem of too big to fail. Which is stressing this has not become worse in general, even though, of course, in Europe, going to the banking union has improved things, because relative to the eurozone, these banks are smaller. But let's face it, our banks are big, are not that well capitalized, and moreover, the system has introduced these GSIP surcharges, but they are more than offset by the ability of banks to use their internal models. And the Basel Compromise is pretty amazing. It says it was the only politically feasible thing, yeah? So, but it says that until 2027, banks can, through these output floors, they can gain at most 27.5% of capital, thanks to their internal model, relative to the standardized approach. And by 2022, they can still economize 50% of their capital. This is much bigger than the GSIP surcharge. And so we still subsidize big banks. We still subsidize size, which is not stressed that much in the report. By the way, a digression on the finalization of Basel III. Banks are, of course, complaining. They call it Basel IV. I think it should be called Basel 2.8, because basically the last phase has reduced the capital in the system. When you do the computation, the final thing that was published in 2018, which was cleaning up a bit the internal models, has in fact resulted in less capital in the system. By the way, it was the eurozone pushing for that, because they have indeed very low risk weights, and therefore go back to Deutsche Bank. But not only. Now, there is a discussion about the leverage ratio. I think the leverage ratio, that was Basel 0 in a sense, before we started doing risk weighting. I think there is one way to justify the leverage ratio. It's at least as a way to get around the 0% risk weight on sovereigns. Dexia, which was specialized in, they had this crazy idea of let's be the world leader in municipal financing, and so zero risk weights and so on. So they could grow without capital. You don't want that. So I would have liked, as a Belgian citizen, to have had the leverage ratio at the time, even though 3% is not great. But what you don't want is to have an excessively high leverage ratio, because in a sense, relative to the capital ratio, because the capital ratio, by inducing risk linked to risk, what you have is a cheaper way of using capital to reduce risk, and so you can have very simple examples showing that. Now, finally, stress test and so on, indeed useful, but let's face it, politics can play a role. You can see a lot of lobbying by the banks. Of course, it's also a imperfect instrument. In particular, we typically have static balance sheet assumption. Now, it's not optimal because banks do react very quickly to incentives. On the other hand, if you start allowing them to have dynamic balance sheets, they will come with zillions of arguments for why it's not that bad because they will adjust and so on and so forth. So maybe from a political economy perspective, that's the best you can do. Finally, as I said, indeed you have to be careful about these cross-border banks because we are talking of a risk of too big to fail, especially if you do that through takeover battles. And I can see this could happen. Maybe some will want to buy Commerzbank and so on. And as we know, it's very well documented in general beyond banking that around 100% of the efficiency gains of these takeovers are obtained by shareholders of the target. The winner's curse is not rare. The most famous or infamous example was takeover of ABN AMRO by Royal Bank of Scotland, Santander, and Fortis. Yes, I'm almost done. So basically, you have to think that on average, when you start running your acquisition, you've already given away 100% of the gain. And so, since some of these battles can involve, teenagers almost, people behave like teenagers who want to win and so on, we have to be careful. So, yeah, that was what I wanted to say. So I'm not against cross-border banking, but done cautiously.
Thank you very much, Matthias. And then Rebecca.
Right. So, hi. Thank you all for coming. I do not have any slides. What I do have are some points and some starter questions, and then I hope you all will ask some questions as well. I really enjoyed the report, I would like to say. I want to spend some more time with it. I would like to encourage everyone who hasn't had a chance to see the actual report to get one and to flip through it. Even if you don't have time to read it. One of the things I liked about it was a lot of its points were easy to digest, and you could read a small section and come away with something that might be useful to you. Maybe not the whole point, but that's a really strong thing in a report like this, to be able to just sort of open it and read a chapter and think, oh yeah, that's interesting, and I will keep that in mind. That said, one of my favorite parts of the report is literally on the first page, where it says, a major challenge for regulators is to gather the necessary political support to take forward the reforms as needed. There really are two sides of every banking crisis. There's the plumbing side and there's the political side. And they require very different solutions, which is why we've ended up with a lot of the halfway houses that we're in now. You cannot focus on only one as much as you might like to in most financial crises. The one exception being the post-September 11th, 2001 financial crisis, where there was no political side. There was just a huge operational side. But most of the time, you don't have a meteor falling like that. So, when you look at this, another thing I liked about this report was it was transatlantic. It looks at the euro crisis and it looks at the US crisis without some of the, usually people looking at the euro crisis like to say, well, ours was the second crisis. The US crisis was first and it sort of pushed us over the edge. Well, yes and no. With that in mind, the fundamental US approach is don't just stand there, do something. If you have a bunch of Americans in a room, at the end of the night, they will say, you know what, we've got to try something, and if it doesn't work, at least we tried. And you saw that with Bear Stearns, with Lehman, with AIG, with Citi, with troubled problem after troubled problem. The European approach is don't just do something, stand there. And I went to many Eurogroups and many summits where they would come in at the end of the night and they would say, we have no choices, but thank goodness we didn't do that plan from last time, because if we'd done something, it might have failed, and then where would we be? And that's a legitimate political choice. You can choose that. It's not, you can hear from my accent, I'm American. It's very alien to me. But after, 8 years in Europe, I've come to respect that is a preference of the people here. So looking at what will work versus what people want, those have to interact. The most radical thing in this report is this idea that central bankers and fiscal authorities should cooperate. That's really a sea change. And from a plumbing perspective, it's a great idea. We hear Mario Draghi, he goes out and he says, look, I'll do what I can, but you guys, if you're able to spend, you got to do it. You can't just be piling up, and this is my own personal metaphor, you can't just be piling up grain surpluses that will spoil because it's better to have a surplus than a deficit. At a certain point, you need to go out there and spend things. But he's a central bank. And is he going to get the Germans to spend? No. I mean, maybe, but probably not. There are so many interesting points that are worth thinking about and coming up. A thing I'll just throw out, because it's a thing I happen to know a lot about, is the direct recapitalization instrument that was developed by the European Stability Mechanism at the height of the euro crisis between 2012 and 2014. This is a thing that was extremely innovative and radical when it was announced, when it was finally put into implementable form in 2014, it was virtually unrecognizable, and we know now in hindsight that it could not have been used and will not be used. This is where I tell you that I recently wrote the ESM's internal history. You can download it for free on their website. It is their book, not mine. Any opinions you might hear from me about it are strictly mine and not theirs. I don't represent them. But it's a good book, and there's history in it. In chapter 34, where we talk about the direct recap instrument, you will see that they ran war games. They ran stress tests on the crisis mechanism. And what they found was that this instrument, which you will recall was created out of thin air as a way to reassure the Spains and the Italys of this world that if their banks fell due to contagion rather than to their own domestic misdeeds, that there might be a way to provide public European-level support without cratering the national balance sheet in the process by making a loan to the government. Okay, so this was the original idea. Well, then, almost immediately, they started adding all of these things, all this stuff. By the time they ran the war games, they ran two. It became clear that as soon as you go into one bank, all the other banks fall down. At that point, the country falls down. At that point, you have to go in and do a full macroeconomic adjustment program of the type that you were trying to avoid. Maybe if you're Spain and you're big, you can hold out and get around this, but Spain, as you know, did indirect bank recapitalization, which is to say the Spanish government took out the loan. The ESM didn't go directly into the banks. I'm going through this very quickly, but it's a real parable for all of these different things that came up in this. And the last point I'd like to make is about communication. To get the political support, you have to convince the public that this is in their interest and that this is, in fact, stability that will make them richer and not a bailout that will make them poorer. Backstop versus bailout. But it's important in communicating this. And even for those of us who follow it, the terms change. Leverage ratio today means exactly the opposite of what leverage ratio meant when I started writing about banking. In the old days, you wanted a lower leverage ratio. You would talk about it in terms of 20-1 versus 12-1. Now you talk about it in terms of a percentage. The underlying concept is there. Having one is good, but explaining it to someone, how to use it, how to think about it. If you're a deputy finance minister in a country where you haven't been following Basel for a long time, maybe you're not even a Basel committee member, this is hard stuff. And I think reports like this can do a good job in making the concepts accessible and making the whole system, the plumbing part of it, more visible to people. Because at the end of the day, it is a plumbing system, and you can't just come in and shut the water off here without thinking about where the water explosion is going to be over there. So those are my wrapping up thoughts.
Thank you very much, Rebecca. Interesting points.
I have a question if no one has one, but we can turn it over to the floor. Yeah. Oh, yes.
Why don't we swap?
You want to swap?
You have to answer all of our questions.
I liked it over here.
You were getting.
Okay,
you were
we have
getting
a
too
change of
comfortable.
cast half the way through the show.
Way too comfortable.
You need to give your mics to the.
Yeah, they did.
All right. Well, while they're changing, I want to ask a question because it's one that came up. In the topic of bridge financing, one of the slides mentioned DIP, which I think is possibly deposit insurance protection. It was debtor in principle. Okay.
Debtor in possession.
Debtor in possession. Well, I wanted to ask how that would work and how it might work for somebody with deposit insurance or without. Maybe that's something you can talk about.
Okay, but let's. There's a lot here in the report, and a lot came from the comments. So I think we should try and sort of actually bundle things up. And I'd like to open up the floor also for questions. But if I may abuse my position for maybe a minute or two, I also like to throw in some ideas. First of all, here, Rebecca, I would also like your views as well. Matthias said that the bailout and the backstop are really one of the same thing. I would like us to discuss this a little bit. Is it really the same thing? And you know, if it's not, where are the subtle differences? I mean, I understand where Matthias is coming from, but I'd really like us to think about that. Because perhaps that is actually a problem in progress in some of the issues. Perhaps that the two are considered more of the same thing. And given the negativity on the bailouts, the negativity on the backstop, is it justified? But perhaps we can throw that in. Rebecca, I was fascinated by your calling the idea of a fiscal monetary cooperation coordination radical. I think that was actually a very maybe I'm showing my age at this. I think that
Monetary cooperation is radical.
That the monetary fiscal cooperation is a radical idea. I thought that was actually interesting that you see that. But I mean, I think the conversation on the central bank independence is a fascinating one. And Stephen, I'm glad you're actually part of this discussion now, because you could tell us a little bit about what the BIS view was on this idea of monetary policy targeting financial imbalances. Is that a good thing? How would that affect the independence of the central bank? And actually, how would that affect outcomes? Because at the end of the day, outcomes is what we want, and means are, of course, ways of going to outcomes. But you have been very, I don't know if this was deliberately, but you have not committed yourself to where you think this conversation should go. I don't know if it's in the report, but in your presentation, you did not express a view on this. And then finally, I'd like to ask the $1 million question. And I think, you know, the capital requirements, and what is an optimal capital requirement? And in order to be able to answer that question, you need to have an idea of what it is you're preparing for. I mean, you know, the number you mentioned, Patrick, of 30% capitalization, if you also include all the buffers, the TLAC, is actually a very big number, certainly by comparison to history. But is it sufficient? In order to answer that question, you need to have an idea what kind of shock you're catering for. You know, so in fact, I think my question here to the authors is, what types of things, in the principal things, do you think we should be thinking about when we require banks to capitalize? In particular, since you pointed out in your presentation a very important trade-off here, and that is the more you capitalize, the less you are capable of performing banking services. And in Europe, we don't have anything else. We don't have capital markets, we only have banks. If banks don't finance because banks have to sort of carry capital, who's going to finance growth? And I'm simplifying, but I'm simplifying for effect. I think that these are sort of questions that are, of course, that they're not new, but I think we would like to have sort of an approach to where to do that. And then the other thing is that I would take to the very last comment, one of the comments that Matthias made on this idea of the eurozone. You did say that we need to take into consideration institutional constraints, but I think in the eurozone we are beyond institutional constraints. We are on governance structures that are very different from many other jurisdictions. You're having 19 fiscal policies, one monetary policy. You're talking about coordination between the two. I mean, what do you have in mind here? How can we go about achieving the coordination, even if it's radical idea? But how do you implement it in the eurozone? I mean, this is the governance issues is perhaps the number one challenge for the future president of the ECB, and indeed for the future Eurogroup. I'll stay here, and I'll give the floor to our new panelists, and please discuss whatever you like, and then we will open up for our public to come to discussion.
First, okay, so I'll start. First of all, thanks very much for these terrific comments and questions. And I guess my overall reaction is that I'm very pleased with the reception that we're getting, and that people are finding this both useful and informative. And I guess when you produce something like this, you hope that 10% of it is useful and informative. So I think that hopefully we've met that. I want to make several general comments and then try and answer one specific or two specific questions. First of all, I think it's very important in the current environment to keep in mind that left to their own devices, banks will hold too little capital and too little liquidity because they do not internalize the social costs of their activities. What that means is that the business of the regulator is to force them to internalize those social costs, to increase the cost of doing business beyond where they would be. They will complain. If they're not complaining, you haven't done enough. And so don't listen to their complaints. Some of their complaints are okay, but by and large, I would say, my rule of thumb was they better be screaming. And if they're not screaming, I need to do more. Now, this is so. Then the question is whether we've done enough or too much in certain dimensions. Okay, so but that's the first thing. I think the second point, which is really important, especially in the context of the euro area, is as one of my friends said years ago, you cannot deleverage by borrowing. So if you think that the cause of a problem is too much debt, do not run policies that ask your banks to lend. Okay, that's the second point. So the fact that euro area banks are contracting their lending activity is intentional. That is what we are trying to get them to do. The fact that they are shifting, as they are, activity to other non-banks is what we are trying to do. This is, remember, these are intended consequences of the regulatory reforms. It's really simple. The idea is you have too much debt in the banks are too big, force them to shrink, and force them to do it in a way that increases their capitalization. On the question that you raised, both of you, about bailouts versus backstops, I will try and channel Patrick a little bit on this to say that if we have a resolution regime that is actually operating as designed, then the backstop / bailout problem should go away, okay? Now, whether we have such a regime, I'm not 100% sure. The problem that we were pointing out, especially with the SEB's original 2009 stress test, which didn't even stress, by the way, for those of you that, if you go back and look, you'll discover that Greek debt was not stressed. Okay, Greek debt was allowed to be held by the banks in the stress test in the summer of 2009 in the euro area at book.
Basel rules.
So
it says so.
And so, yeah, but the stress tests you should be allowed to do this. Anyway, that's a different. So the but if it works, that's where I think you should be. The question of what I think that one of the biggest embarrassments of the finance and banking part of the finance profession is that we cannot answer the question of what the optimal level of capital is in a bank. Okay, I do not think we have a good answer. I think our answer is that it's not 0 and it's not 100%. But it's somewhere in between. But that's not a profound answer. So and then the question is whether or not how we want to deal with the fact that, for instance, total assets to risk-weighted assets, as you go even in the major jurisdictions of the world, vary from, say, I would say about 1.5 to about 3, and that really makes leverage ratio, risk-weighted asset requirements sort of have very different effects as I go from one jurisdiction to another because of the differences in the business models. I'll let you answer the hard questions.
Yeah. Why don't you take 2 minutes?
Just a few minutes to,
Sure.
I mean, on one basic issue, and without going into the detail, I mean, is fiscal monetary coordination a radical idea? And I think what basically we come up, and one important point in this report is that basically we didn't go into the details of the eurozone. We didn't go into all too many details that was too American specifics. We could have gone. We wanted to stay one step back and look at the general principle level to see, just instead a few ideas that might be useful at all levels, but of course that need to be developed according to specific institutional setup. Now, I think one thing that we believe, we clearly say the world has changed, not only for all of us, but also for central bankers since 12 years. This has led to de facto a bigger role for central bank, but also normatively they should accept a bigger role, in particular in the domain of financial stability. I mean, we have this view that essentially the goal of price stability, which is the narrow definition of what central banks try to do, it's really a means to a goal. The goal is macroeconomic stability, and macroeconomic stability without financial stability, you don't have it. So the central bank have to grasp that concept and move determinedly forward in this direction. The problem is that there's been a huge acquis. Try to say what is the translation of acquis earlier today.
Mission is.
What is the acquis of the end of the 20th century is central bank independence. And how do you reconcile the two? And you have seen, all of you have seen not only Mr. Trump's tweet, that's not what we are after. It's more deep comment on or questioning about central bank independence, which have to do with the fact that they are much more visible, they are much more active, they are much more into the melee of political discussions. And so then the question, can we do it? And I relate that to political coordination because macro coordination, the way central bank independence was interpreted was really send a few technocrats with a very defined mandate on top of a hill. They'll work with them. They're not going to mesh with the rest of us, but they know what they have to do. If they don't do it well, they'll be killed. If they do it well, we won't touch them. This makes it as a very difficult model to engage into a discussion with political authorities. It makes it a model that is impossible to practice if you want central banks deeply involved in financial stability, because there they will not be able to do it all on their little hill upside. They will need to be meddling with political authorities, with other institutions, with financial regulators at some levels. And basically what we are saying, okay, we need to take a step back, and you mentioned the word communication and explaining, and it's really much in our text. How to do it? Not clear. It's possible to do it, but the precondition is that they need to be a public discussion. There need to be a debate. Central banks should not hide under the carpet and say, okay, things are fine. No, we are not. No, we need a public debate on this issue. And we believe, of course, and here we can more from the macroeconomic side, if we believe that we are going to be at the $0 bond for a long time, or that we are going to be repeatedly at the $0 bond in the future, we cannot leave things as they are. We've got to define a setup which has to be country-specific or continent-specific, depending, to make sure that the discussion can start again without endangering central bank independence. We are convinced that it's possible. It's clear that we are fully adhering to the Paul Tucker's book, who has been investing a whole book on that. We think there are very good ideas in there. So it's possible, and we should not refrain from engaging into that discussion in order to reach that goal. This is true macro, fiscal and monetary policy coordination, but it's also true in financial stability, where there you have de facto coordination problem, whether you want to address them or not. If you don't address them, you're going to have a big loss of efficiency and accountability. And we see that we are a bit in the middle of the river at that stage, and this is a risk for the future.
Thank you very much, Jean-Pierre. Can I then perhaps open up the floor for kick some questions? We have a little bit of time, particularly if you're a banker. This is your time to... there's a gentleman there, a gentleman here. Any other questions from the back, perhaps? There, okay. If we take 3 questions and come back. So here, there, and in the middle.
Hi.
Can you please introduce yourselves first?
Yes, I'm Niels Bjorksten. I'm from the European Commission. When I saw the title of this Sound at Last,
Can I have a word?
I was wondering how things are actually looking on the ground. And you've talked a lot about the primary legislation. You've got the different titles of Dodd-Frank. On the one hand, you've got the corresponding primary legislation in Europe on the other. But all of these require a whole lot of agency rulemaking. For example, getting information on derivatives and so on, getting an overall picture of where risk exposures are. How is that looking? Are we sound at last on that?
Okay. Thank you very much. Here.
I can make up an answer. Stas Sinopoulos, formerly of the European Commission.
think one or two panelists mentioned the question of political acceptance, whether politics is at the source of the problem. We know quite well that in Europe right now, the politicians and even the average citizens is concerned about the stability of the, let's say, of the banking system, the financial system. But more important for them is they're questioning whether the financial sectors in Europe are contributing substantially to the real economy. I came back from a trip to the United States, actually. I have contacted...
Can I please ask you to ask the question, because we have others who want to...
My question is, in the United States, right now the feeling is that the financial sector contributes only 30% to the real economy. My question is, do we have any evidence that in Europe there is such a risk, let's say, to go in that direction, or our financial sector makes a much more substantial contribution than to 30%?
Okay, that's a very clear. Thank you. And then there was, just behind it, there was a gentleman there.
Ingrid Rostig from the Permanent Representation of Germany. First of all, thanks you very much for your presentation.
Can't hear you.
We can't hear you. Can you please raise your voice a little bit? The mic is on. It says you need to... Yeah.
Okay. I've got a question regarding TLAC and the BRRD, because you said that TLAC is basically better designed than the things in the BRRD, I think MREL especially. And the question is, what would you change, including the thought of proportionality, which we have in the European supervision system?
Thank you. And then the gentleman at the front, actually, we should take this fourth question here.
In Patrick's single point of entry model, assuming Mathias de Vatripon gets his European cross-border banks, where's the money for the backstop going to come from?
Thank you very much. Any other questions before we go back to the panelists for last comments? Attempted answers, last comments? Okay, then let's go back. We have 10 minutes. We'll come back also to that.
Well, I'll just take. I mean, I neglected your question about targeting financial imbalances.
Yeah, I thought that was deliberate, actually.
It wasn't entirely deliberate, although I can see how you would have interpreted it that way. And just for the record, you can go back and see I never made public statements that actually supported that. My view is that you do have to do these things more holistically, but that the first line of defense against financial stability problems is prudential regulation, and that if you feel that there is insufficient resilience in your system, what you need to do is find a way to get it, not reduce or raise or whatever interest rates. Interest rates are a very poor tool in my view for ensuring that your financial system that your financial system is resilient. The question of how things look on the ground in the U.S. poorly is the short answer to that. I think that there's a lot of, as everyone certainly in Brussels and places that do a lot of, that are involved with rule writing, you know that the details matter intensely, and the way in which the rules are being written and enforced in the U.S. right now, in my view, is not great. On the TLAC, I'm not sure I quite understand entirely the question, but I will say one thing about this, and that my own view, not speaking for everyone, is that overall there may be big enough buffers in the system today. The question is whether or not the balance between capital and other forms of debt are really the right ones. If we shifted towards more capital and away from various kinds of subordinated debt, it could address some of these other problems also, including the ones associated with how it is that cross-border resolution or at least cross-border transfers might end up working. I'll stop there.
Thank you, Stephen. From here.
Okay, maybe on the question of political acceptance and the role of the financial sector, I think here there is a question of reality and perception. I mean, if the crisis has shown us something, or if the effort of the ECB today, for the last 7 or 8 are worth anything. It's that, yes, we depend a lot on the financial sector. When the financial sector doesn't work well, we have a real problem. So it is no there is no antagonism between Main Street and Wall Street. It's just that we've got to explain better and certainly make sure, and that's where maybe the question of remuneration comes back. We have to make sure that a number of things are in place, stability on the one hand, and indeed, when we identify the fact that we are subsidizing banks, we'd like them to show a bit of moderation in terms of remuneration. But that's more, it's part of communication, and certainly we believe that we need a sound financial sector. We are convinced that significant progress has been made. We are not totally there yet, and there are still a number of questions. Just as an aside, let me give you the Swiss view on backstop and bailout. The Swiss view is that bailout is a no-no, simply because our banks are too big to save. And so we say no, but of course liquidity backstop. And that's one of the main messages in the resolution chapter. It's a denial to say that we won't need it. And that's again, it's a lesson of Diamond Didvik as well, right? I mean, you need to be there with the liquidity backstop, but it's very different from outright bailout. On financial imbalances, I wanted to say we come up somewhat towards the view that from a pure efficacy viewpoint, it'd be nice to have everything under one roof. Then these questions about financial cycles and macroeconomic cycle they are totally internalized. And again, so we have a little push in favor of the Bank of England model. We believe that it's a very demanding model, which has led them to take significant step in terms of public explanation and transparency, and that's a model to be followed. As we said, I think one of you said, we don't think we have to take institutions as they are today, and they are not going to be changed. Most of them are in place since a few years only, but we can take that as a model, and indeed this potential distinction between financial cycle and macroeconomic cycle lead to point out very directly to this coordination issue that we have mentioned in the financial stability domain, which is something that is totally, in many places, unresolved today.
Yeah.
Maybe you should have just answer the question of, because I'm not able to answer the distinction between the TLAC and BRRD, but you would be the right person to do it.
I'm sure you would. We'll come to Matthias actually, but would Patrick or Xavier, would you like to make any comments on this? No? Okay, then we'll come back to...
Did you want me to answer about debtor in possession finance?
I'll ask you afterwards. I won't bore everyone with that.
You can ask.
But I am interested.
Okay.
And then Matthias?
Yes, I will be brief. The first thing I'll say is that this Deauville agreement, that euro area sovereign bonds could be written down, the idea that a euro area country could default was unthinkable. And that was certainly the U.S. position. The U.S. went so far as to bail out Mexico so that it would not have a sovereign default on its doorstep. So not stress testing sovereign debt in the context of the time, I think it makes a little more sense than it does now that this seismic shift has gone, and certainly within the euro area, you can have a default. I mean, that really changes things, and it comes back to, I think, what Matthias was saying about once somebody has a run, everybody else wants to run. On backstops, if you have to ask if your backstop is big enough, it's not. That's how they work. But about this question about who will pay for it, this is interesting because this is a third point that I wanted to make about communication. If you make the right case for it, you say, look, if we do this bailout right, we will make money off it. The money is in the bank stacks where the money is. So it is in our interest to minimize the pain on you and to maximize the profits for us. If we leave it to the private sector to do, they will maximize the pain because they will come in at the lowest possible price. They will maximize their gains, so you will minimize the gains. So you have public losses on both sides. And then my last, and I'm sorry, I didn't mean to be in any way disrespectful, but regarding the difference between a liquidity bailout and a regular bailout, if you do it right, they're all liquidity bailouts. Every single one of the US bailouts, all that money came back in. They made money on all of it. The only part of the US financial rescue that they did not turn a profit on was the 40 billion, which is not that much in the grand scheme of things, the 40 billion American dollars that went to individual homeowners to help with foreclosures.
The auto industry.
And the auto industry, which was a small amount and which was an old-fashioned corporate industrial bailout about which you can say a lot of things, but they're not banks. I think we can all agree there.
Not banks.
So in terms of where the money comes from, you squeeze the banks afterwards. You create a framework which says we will give you liquidity.
Comment on the Irish case, maybe?
You know, this is another great conversation. The euro area put a lot of pressure on the Irish to guarantee everybody, to not allow any private investor to take losses on that. And that's when the Irish inextricably merged the bank and the sovereign finances, which eventually brought them down. That's a complicated conversation, but if you start, as I do, as a good American, with the idea that a country, which was a political sovereign idea, and a company, which is a bunch of people with private money, that they should be treated differently, you maybe get to a different answer there.
Thank you, Rebecca. Matthias, final words.
Well, on MREL versus TLAC, I think that TLAC was much more prudent. There was the proportionality aspect, and it's only GSIPs, while here it's for every bank, the 8% rule. And more importantly, also the sequence was much better in TLAC, while we had the 8% rule immediately for all the banks without having anything in place, and we are gradually getting there. But now, on proportionality, I do agree that at some level, it is strange, to say the least, that TLAC for GSIPs is, in terms of non-risk weighted, is 6.7%, while here we are 8% for all the banks. Now, there is also the component on capital ratio, but somehow it looks like Europe is overdoing it. Indeed, proportionality would make a lot of sense. You know, Europe is the only place in the world which is Basel III non-compliant. I don't know if you knew that, but then the next worst pupil in the class is in the US. There is obviously a correlation with size, but they are, I think, broadly consistent, whatever. And then all the rest, they are fine. You know, from Turkey to Russia to China to whatever. They are all fine. So I do think that it would be much better in the EU to be compliant with Basel III on a restricted sample of banks. I think in the US it's like 19 banks that have to be Basel III compliant. Here, you know, the ever closer union, blah, 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 all the banks have to do it because, you know, Europe should do everything, which I think doing everything badly is not great. I'm not saying, of course, that we are hugely non-compliant, but, you know, and the European Commission, so they were not happy to see that the things went this way. But at some level, it was a bit unfair, this mark, but not that unfair. So anyway, I do think that it would be nice to definitely lower the 8% for the smaller banks. And for the rest, I do think that indeed we should think more seriously about this bailout backstop thing. I think liquidity backstop, if I may say so, is a bit of a cheap answer because the real question is when we will lose money. And at some point we will. You know, on KBC, there was a bailout and the Belgian and Flemish taxpayer made a killing on it. On Dexia, no. And it's not, the story is not over yet, but you know, we won't recoup everything. So clearly at some point, there are really bad banks and you will need to chip in some money. Now, it's never great.
The profits on one offset the losses on the other?
Now, right now, and Belgian banks didn't do well in the crisis, but by now, and of course you need to look and you have you have to see what is the implicit interest rate and all that, but we are not that far away from break-even at this point. So the money made on KVC was roughly the money lost on Dexia, but a lot of it is still guaranteed. So You have to be careful. Dexia is still almost 200 billion bank. But I think, I mean, you also have to factor in the fact that not procrastination is very costly for growth and therefore for taxpayers. And, deleveraging is the point, yes, to an extent. But as we know, deleveraging that goes on very slowly can be awful. Think Japan. That's what they did, denial, and that was a disaster for growth. So I think the best idea when you have a systemic crisis is a big bailout, nationalization, restart the bank, and make it up with growth. That's Sweden. That's the US 2009. And then it can pay for itself, even though some... Now, of course, when banks know they will be bailed out, that's not great. And indeed, at some level, whether it's pre-funded or not, so it goes beyond the taxpayer. It's an incentive problem. But, once you get a kind of a systemic crisis, banks can also be victims of these kind of things. So there was this, I think, Kashyap, Stein, and Rajan suggested capital insurance so that banks would chip in money, and when there is a big recession, you give them some of the money back, some insurance, not based, of course, on their own performance, but on aggregate performance to avoid moral hazard. That's a pre-funded bailout, not a liquidity one. It's a capital bailout. These are the difficult problems, even though I fully agree that liquidity bailout, again, it's a way to reduce the reluctance, and it's a useful way because liquidity is a little costly, but at times it can be. So pure liquidity is never sure. So anyway, that was.
Okay, thank you so much, Matthias. I'm afraid that's all we have time for today. Let me first thank all the authors of the report for coming here. This is a very interesting discussion, and we'll come back to that. And of course, our discussants. Thank you for coming, Matthias, again, and of course, Rebecca, you're in-house. Please join me in thanking the authors and the presenters for this wonderful